or respectively, illustration, let's say, how lower leverage will boost the overall trading profitability. The thing of this is something I'd already like to mention right here, is the question is whether this is really a given fact, or if it's probably part of a way bigger and more complex picture. I have to say that, I mean, we have seen this already over the last webinars and last events we had together, that obviously position size and thus leverage in general has a natural effect on your overall mental stability, on your feelings, on your confidence, probably also when it comes to your trading in general. And if the position size, to make it straight, if the position is too big, then most likely you'll tend to underlie the classic so-called loss aversion, so that you pick up small gains and say, okay, still, given the big position size, it's probably a gain which is a lot compared to the overall equity in your account, but you let losses get out of hand, since you start to, for example, say to yourself, oh, I can't really afford this, and I have the hope that the market will turn around. So nevertheless, the thing is that after the ESMA decision, which we want to dig a little deeper into today too, and over 1 year now, with the new ESMA rules and the leverage restriction among retail traders, it became clear that the restriction of the leverage here and the reduction to 30-to-1 in FX pairs, for example, or 20-to-1 in indices, that the overall profitability hasn't necessarily increased, but in fact, the profitability stabilized, and still nearly 80% of traders are unprofitable. Sometimes a little higher, sometimes a little lower, but all in all, we come out here at around 80%. So this is already something I'd like to introduce here, or say here. Still, we want to dig into, I think, a very interesting topic here. I think it's definitely worth to remember also the mental stability aspect here, the column of trading psychology and the too high position size affecting your overall comfortability, or you feeling comfortable in your trading, in your position. And so today's agenda, success rate for high versus low leverage. This is what we will want to look into here. We also want to look at the pros and cons why lower leverage is good for retail traders, something I definitely recommend. I mean, we can, even though it's not necessarily true that a lower leverage boosts the overall profitability, at least not alone, it still increases chances of long-term profitability in a way where you can say, okay, a lower leverage then means reduction of the position size, very simple, said, which means nothing more than you give yourself more room to breathe. You give yourself more room to make mistakes in your trading, which will naturally happen. And this will give you more time to develop a strategy, an approach with a positive expectancy, and then start to trade your way to financial freedom. I think that was a book title from Van Thaver, I think, or similar to that at least. And so this is definitely something which is definitely true. So lower leverage definitely will somehow result in long-term profitability, give you room to breathe, give you room to make more mistakes in your trading, which you will naturally do, especially if you're a beginner. But still, you have to find a trading strategy, a profitable trading strategy, which will give you an edge in the markets then. And one of these is the DAX30 open range breakout strategy I've already presented in one of the webinars in the past. And we want to look at the strategy from today's perspective. In fact, today we had a losing trade with that, but this is not the question here. But I want to show how you can trade the strategy still before and after the ESMA decision, and it doesn't necessarily affect your overall trading in general. And I also want to show you our Traders Yard forum section where you can ask all your questions, not only here below the video. If you're watching right now the recording, by the way, please leave a thumb up. There, respectively, if you have any questions arising from the content I provide to you now, ask the question below the video. it will definitely be answered. I guarantee you that. And if you do not want to ask the question below the YouTube video, reach out to our Traders Yard community. I'll give the link at the end of this webinar here, where we not only answer questions, but also, for example, trade every day 2 setups here, which I presented. And there's also Marcus and Paul who will answer your questions based on their webinars. Next one, by the way, is on Monday with Paul, but this is also something we want to dig a little deeper into then at the end of this webinar. Yeah, so who am I? We can now go through all these points. I think this doesn't make really sense, but instead I recommend to read the interview I did with Admiral Markets before we started this Trading Spotlight series. The first and probably only thing I'd like to say is that I'm located in Berlin, in Germany. And why is that of importance here? It's of importance because Admiral Markets, who makes all this possible here, has also an office here in Germany, in Berlin. And not only that, by the way, but around the globe. So Admiral Markets is definitely a global player in the CFD and FX industry with, as you can read it here, over 8,000 financial instruments being offered here. I mentioned already this, offices around the globe. 20+ countries, that is not restricted to the English-speaking world, but also, for example, also to Chile. I think there Spanish is the language then. So all of this is something definitely to consider when choosing your broker. Do you, for example, have a customer support in your native language? In case of Admiral Markets, you have a high chance to have someone to speak your language here. And in addition to that, it's also regulation, which is a very big topic, became a very big topic over the last months, especially after ESMA, and also in regards to the Brexit question and everything. So here, Admiral Markets is also very well positioned, not only licensed by the FCA, but also by the CISEC, for example, for the European region here, but also by the Australian financial regulator, the ASIC. So definitely worth giving it a deeper look. Also, when it comes to pricing, I can say, based on my personal experience, I'm trading with Admiral Markets, by the way. So the DAX offering is highly competitive, probably the best in the market, with the standard spread being 0.28 through main trading hours. In my case, for example, I'm trading with a spread of 0.2 with the commission on top. This is the so-called Admiral Prime offering. So also here, have a deeper look at what Admiral Markets is offering here. And so now let's have a look here at a chart, which is probably probably already showing what I'm after here. It's a chart which shows the profitability in regards to the so-called used effective leverage here on the x-axis. So the effective leverage is something we want to introduce in a later or in the next slide, in fact. But here you can already see one thing. The lower the leverage is used, the effective leverage in this case is used. By the way, it's very simple to calculate it. You take the position size you're trading. Let's assume you're trading EURUSD, for example, and you're trading one lot. This is 100K. And then you divide this number, 100K, the amount you're trading, you're moving in the market then, you divide this by the account size. So in fact, if you're trading a 10,000 euro account, for example, and you have a position in EURUSD of one lot, it's 100,000 divided by 10,000, it's 10. So the effective leverage in this case is 10 to 1 then. So I'll show this in the next slide in a little more detail here. And what you can see is here, and on the x-axis, the lower the leverage, the higher the profitability is rising during this time span we are analyzing here, which is something which is, in my opinion, not something which comes as a surprise, since we know, as I already said during the introduction, but also in the former webinars here, when it came to the 3 columns of profitable trading, for example, I was referring to the mental stability when it came to trading. If you're trading too big, the size of the position in relation to your trading account is too big, then usually bad behavior is the result, or emotions taking over, and you do something you shouldn't necessarily do. Picking up a winning or being in a winning trade, and then try to tend to, for example, take out the trade before it hit the take profit level, respectively start to hope that the market will turn around after the market starts to move against you, and you're just sitting in front of your screen completely paralyzed. The lower the position size and the lesser here the impact on your mental stability in regards to the P&L, respectively, the lower the leverage. This is the same in this regard. The higher the chance that you will be profitable, because you're more likely to keep trading your strategy and stay with the strategy and do not discretionary intervene here. Sometimes it can make sense, but in the long run, the experience, at least in my case, shows that such discretionary interventions are minus EV, we say. So it has a negative expected value, which means it costs money. If you're profitable, you're less profitable, and if you're not profitable, it means that you lose even faster the money in your account then. And so the thing is that the less you intervene in your trades and you trade with an adequate position size in regards to your overall trading equity here, the higher chances of your profitability. So to give the numbers here some meaning, during this time span we analyzed, it was between 2014 to 2015. It's an average, not average, it's a time span, a period of nearly 1 year. Or it was 1 year, in fact. And we already had a look here, for example, at Euro USD in one of the webinars, where I said that we analyzed 9.5 million trades. And I tried to show you, last week was it, and when we talked about the expected value here, I wanted to show you that based on the numbers retail traders were putting in, having a hit rate of over 60%, but a payoff ratio of less than 0.5 to 1, that based on that, they were all in all negative, losing around 2 pips per trade. And so in this time span, you could also analyze the used effective leverage of traders. And what you could see is that here, 40% of the traders who were analyzed were profitable, who traded with effective leverage of 5 to 1 or lower than that. That means nothing more than, as I already said, if you're trading a 10,000 euro account and you're, for example, using a position size of 3 mini lots, which means you're then trading in Euro USD in this example, 30,000 units here. You divide 30,000 by 10,000, you get 3 to 1, which means you're below 5 to 1, and you have an increased chance of being profitable in your trading. To give you a number from my trading, for example, when I trade, the overall position size and respectively the used effective leverage is 2 to 1, if not lower than that, which already gives you an idea of whether I'm profitable or not. It does not, as again, it does not necessarily mean that you're profitable because you're trading small position size. If you do not have a profitable strategy with a positive expected value, you won't be profitable. Still, you can, based on this graphic here, already see that chances are increased that the one using a lower leverage will likely be profitable, more likely be profitable in his trading. While here, for example, traders who were analyzed here and had a leverage of 25 to 1 or higher than that were only profitable in 80% of the cases. So that nearly was divided in half if you increased the effective leverage in your trading massively. So what does the effective leverage of 25 to 1 mean? It means that with a 10,000 euro account, for example, you were trading 250,000 units Euro USD, so 2.5 lots or higher than that. And the higher you trade here, the higher the pip value in this regard, the lower chances of you being profitable in your trading. And this is already it. So I could really end the webinar here. And the only thing would be, I'll take this as an information, but we will surely dig deeper into this topic now. But you can already see it here based on all analyzed trades that there's a correlation between profitability and the usage of leverage in your trading. So now, I want to give you a little more idea about this. So the thing is, I was talking about the so-called effective leverage. This is obviously not the nominal leverage. What is nominal leverage? This is what you see when you, for example, go to the website from Admiral Markets and then open a trading account as a classic retail trader. If you're allowed, then you're then allowed after ESMA, you're allowed to have a leverage of 30-to-1 in your trading. This is what we call the nominal leverage, but it's not related to what we talked about in regards to the effective leverage. It's very important to know that. Still, I think there is a correlation, and something I want to show you then in a few minutes here. So, increasing the chance of being profitable, how can that be? And here effective leverage comes into play, and the question, what is effective leverage? We already introduced it, but here is it again in written form. So the effective leverage is defined as the position size you trade divided by the account size. So example, you plan to trade one lot Euro USD, which is 100,000 units, or in regards to, for example, the DAX, you can also say if we have currently where we trade, I think it's 12,000 points or something. Shortly before we started the webinar, I think DAX was trading around 12,000 points. If you trade one CFD in this regard, it means that you multiply 1 with 12,000, so you have an overall value of the position of 12,000 euro in this case. And then you would divide 12,000 by the account size. Let's assume it's 10,000 euros. So when it comes to the 12,000 one CFD position in the DAX, then you have an effective leverage of 1.2 to 1 here. So the effective leverage is very low. In regards to one lot Euro USD, 100,000 units, it's 10,000 divided by 10,000. It means that the effective leverage then is 10 to 1. Okay, so, but now the question was more, how do nominal and effective leverage interact with each other? Obviously, this is a very individual number here. It has nothing necessarily to do with the leverage being offered by your broker. But I did a very simple example here, but I think everyone can get this. I put it in one sentence. I said, the higher the nominal leverage offered by your broker, the higher the chance that you use it. Okay. While I know, I can say that I did this presentation, or I used this sentence in this regard. I used this sentence during a German presentation, in fact, and then someone really felt offended by it, and then said, "Hey, no one will tell me what position size I use in my trading." It's not about tell someone what to do with his money. I mean, everyone is free to do whatever he wants to do, but I think the overall target of trading in case of everyone is to make money, at least in the long run, and not bust your account several times over and over again, and then after being hit and feel all the pain connected to lose money, then probably stop trading completely, or then rather sooner or later picking up what profitability in trading is about. And so please don't misunderstand that right now, but it's in case of the leverage and nominal and effective leverage, how it affects each other, it's like giving a 5-year-old a box of candy and telling him not to eat everything at once, and then after leaving the room. We all know that the 5-year-old, since we all were 5-year-old, and I was exactly that, there's no discipline, and there's no real understanding of why shouldn't I eat the whole box of candy here. The same is true when it comes to leverage. So a broker offering its traders, also retail traders here, a leverage of, for example, 1,000 to 1. That's too much, probably, but 500 to 1, let's say. 500 to 1 is something which is very difficult, because people most likely will use this. They think they have to trade big to be recognized as traders. This is far, 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 far away from the truth. And we had this during our Trades of Successful Traders, also in this webinar series. You can find all those webinars, by the way, here in the YouTube channel from Admiral Markets. So feel free. It's, I think, probably 3 or 4 weeks ago that we had this topic. That while professional and profitable traders are self-confident, they're still not ego-driven. This is the big difference. So successful, profitable traders don't have an ego, but they're very self-confident. They know their strengths and they know their weaknesses, and they do more of what works for them, more what is connected to their strength, and they try to reduce what doesn't work for them and where they would find themselves in a weak spot. The same is true here in regards to trading. But the thing is, if you are offered it, you use it. And this is natural behavior, and based on my experience, what just happens. So it was nearly clear that ESMA would come out here, the regulatory body here in Europe, and do something about this and reduce the chances here. Or let's put it here in the picture of this box of candy. It's like you take out half, or probably 60–70% of the candies being within this box. But still, at the end of the day, there's enough candy to make the 5-year-old feel sick, let's say. And this is true, and is what we already know here. Still, we want to dig a little deeper here. First of all, before we start with an example based on today's open range, let's have a look here at the pros and cons of lower leverage. So the pros are obviously that lower leverage increases the chances of being profitable. Probably we have to make a little relation here. 1 second. Oh yes, yeah, sure. The question is probably in regard to the DAX strategy. You can find it also on the Admiral YouTube site. There was also a webinar we-ran here within this Trading Spotlight series, but probably you don't even need to go to the video here, even though I recommend it. But still, we will go through the 3–4 points here within this webinar. So it will be quick, but nevertheless, you will get already an idea of what the strategy looks like. So no need to worry here. And also, it's something you will find in detail written down in the Trading Spotlight community. Then there's also the setup given right at the beginning of the thread we opened there. So yeah, the pros and cons of lower leverage. So lower leverage increases chances of being profitable. Again, there's now details. I haven't prepared a graphic on this, but I could show it to you. Probably I can also screenshot it and post it then in the Trading Spotlight community. You will see that the overall profitability not necessarily increased here. Nevertheless, I think it's still a pro. But you have to probably slightly adapt it here and say lower leverage increases chance of profitability because it gives you more room to breathe and gives you more room to make mistakes in your trading, which comes naturally, especially to those beginning with trading. And so deep knowledge, in case of pros here, deep knowledge about key parameters of one's trading is necessary to take adequate steps. For example, focusing on a balanced strategy mix based on personal risk parameters. It's also very important to make sure that you really, when it comes to leverage, know what are your strategies and what are the margin requirements I have to fulfill here. And this makes here, sure, you have to really dig deep into this topic and to really understand what effective leverage in this case is about. And you will also analyze your trading accordingly. So which makes it, if you know about this relation here, which makes sure that you really try to understand your trading better and really try to take steps then to balance your portfolio mix, whatever, respectively, to improve your overall risk parameters. The con, which is also something which is mentioned, to me, it's difficult to say that because I know that trading, if it's profitable trade, professional trading, or it's also trading as let's call it a second source of income, or something some people do as a hobby, even though I wouldn't really recommend trading hobby-wise. But the thing is still that I know, after several years of experience, that trading is a very, very capital intensive environment, respectively, undertaking. And so which means nothing more than I know that if you want to make money, you need money. And that doesn't necessarily mean that you have to risk all of your money, but still, to me, it comes natural that if you want to trade, you have to put in a certain amount of money on the table. It became already quite, let's say, not easier, but even people who didn't want to put in lots of money in their trading account, yeah, got better chances to access the markets by, for example, let's look at Admiral markets here offering micro lots, for example, something which wasn't possible and wasn't a topic 20 years ago. So well, 20 years probably a little too much, but 15 years ago, let's say. So when the CFD industry became more open also to retail traders, and then when people got access to financial markets via trading CFDs, for example, you weren't capable of trading micro lots. That wasn't the topic. So you had 1 point for one CFD, and that's it. So today you can trade 1 point with an value down to 10 cents. There's also offering where you can take 1 point is 1 cent, for example. But still, what I try to tell here is, right now it's already possible to reduce the amount of money you are willing to put in your account, even though I'm one of these guys who really has difficulties understanding this. Still, I'd like to put it here on the con side that potentially more capital is required in your trading account, for example, or a reduction of your position size is necessary, which then nevertheless naturally results here in your overall used leverage in your trading to decrease, which then will allow you to make more mistakes and gives you more room to breathe and become profitable in the long run on the other hand. So you can see that all these points then to some extent already or again interact strongly with each other. So now here the slide in regards to the question. So the open range breakout we want to look at here for the DAX30 CFD, and the steps we go through every morning, by the way, also in the trading spotlight community. I will switch to this then for today's example. After going here through the definition and also through an example from the real world. So we do the following. We define the open range between 8 a.m. to 9:05 a.m. in the morning. Before you ask why it's 9:05, that has something to do also, and most of it already has something to do with that, that the Xetra open, the cash market is opening at 9 a.m. in the morning in Germany here, and you see plenty of volume pouring into the market there, and there's a lot of erratic behavior and pushes up and down. And I try to filter the noise which is caused here by the spot market to open. I try to filter that out, and that's why I look at the 9:05 candle here in this case. So then we say, okay, we have a high and we have a low. We have to then look at where do we have the advantage today, and that is done by using a simple approach, an ESMA 50 here on a 5-minute time frame. And we say if we trade above, we only take breakouts on the upside. If we trade below, we only take trades on the short side. And then these are these two steps here, and then we trade the break of the open range in direction of the identified advantage, stop above or below the high, respectively low of the range. And the last point is, after defining our stop, okay, where we position our stop, the take profit level, it's a predefined risk reward ratio of 1 to 2 here. There's one case, I haven't written it down here, but you will find it in the Trader Spotlight community. What happens if we are not stopped out and if the market has not hit our take profit level at the end of the trading day? The trade will then taken manually out wherever it trades right at the time. So you take it out 10 minutes before the future closes, which is at 10 p.m. German time. So it's 9:50 German time when we take out the trade, no matter where it trades, if it wasn't stopped out and the take profit level wasn't hit. And so here's the setup in the real world. 1 second, let me just check. Yeah. So we have here the open range with those lines, those horizontal lines, the red ones here, between 8 a.m. And 9 a.m. Central European time, the high and the low. And then you can see here we are breaking lower, and this is the thing. Let's go back again. You can see it here. I can't zoom into the chart now, but you can see that this last 5-minute candle here, this one, before we break out of the range on the downside, closed slightly below this blue line. So it's a real example. So this is not what you will find in the book probably. So in the book it will be clearer, but I love to work with real market examples, because this makes only sense because we are trading real markets. So it doesn't make sense to have something like a self-drawn chart or something like that. And that's why it's a little difficult, but still I strongly believe that this is the best way to put it here, even though it's probably a little difficult to see it, but you can see it there. If you closely watch, you can see that we closed with this 5-minute candle below the EMA 50, the blue line in this case. So only short trades were taken then, and the order was here entered once the market broke out of the range on the downside. And so where do we place the stop? We place the stop here above the highs, while then we duplicate here this range and multiply it with 2, and then you get out here. This is the region where your take profit is hit. It's a perfect example, because then you can see the market turned around. But this is how the setup looks, in fact. And so now I've prepared the following for you. So just to give you an idea of why. Where do we have it? Here, there we go. So this is the Trading Spotlight community. And by the way, I can already say it right here. I give you the link in the chat box. 1 second, I have to change this. So I call it the Spotlight group, okay? So, and here every morning and also every day. So in fact, right now, right at this moment here, the U.S. market market opening is going through, and it's not only that we focus on the DAX. By the way, the stop was triggered, trade was stopped out today, but we also have a setup here for the S&P 500, and I go through this every day, and not only to give you the setup and then tell you, okay, now do something with it. I don't care about you anymore. But you can ask, first of all, you can ask questions here. For example, look at Swajunas. I just saw that you asked a question. I hope Swajunas is right. I spelled it right. So he is asking, for example, some questions here, which I love to answer. For example, here you can see it. So if you have any questions among these setups, first of all, you can ask those questions, and we are there to help you. So it's not only me, but also Marcus and Paul. And in addition to that, it's not only that we have the setups and then take it from there, but I also did something which is probably quite unique, but I think this makes the most sense. And I already told you that I love to work with real market results or real market conditions. I track all the trades here with these two strategies with this FX Blue account. I connected this, so we are trading this. Sure, from a regulative perspective, we have to make sure that it's a demo account, but still the market conditions in the demo account are nearly one-to-one the live market conditions here, depending on volume and everything. So for example, I right now have to see whether after the stop out occurred in today's DAX trade, we got slippage here or not. I know that in the real environment where I traded the trade, where I had this trade too, I had some slippage, but this was market induced here. I'm not sure whether we saw the slippage here also in the demo account. But all in all, 99%, 99.5, I'd say, results are the same. And not only that, again, I try to document the trades here and to show you how important it is to document it, and then also take steps. So right now it's beautiful to see that, because we started the project, we connected this account here, I traded, and right now we have a hit rate of 75%. So for 2 weeks, the equity curve knows only one direction, and it's on the upside, which is beautiful. But this is not how it is supposed to be, and this will change rather sooner or later. You will see a drawdown, and then we have to take steps. But I'd like to show what steps to take based on real market results here, and also when to change then from the aggressive mode to the let's call it conservative mode, when we have to take the break or have to take a break, or calm down a little, let's say, or de-accelerate our trading here, to make sure to position ourselves adequately in regards to the changing market conditions for our strategies, for example. But we can only do this if we have real results here. The same is true for working with things like expected value, payoff ratio, and risk of ruin, for example, run Monte Carlo simulations. We can all do this with hypothetical results here, but I think it makes the most sense to have real market results here. And this is also what I try to achieve here. And yeah, so far, what I can say is that in around 40 minutes from now, so 4:15, the range, we will have a range here in the S&P, and then just join the community here. And by the way, you have to hurry up because we decided to give it a 1-month trial, and afterward restrict the access here to all the people coming after that date to the community, to only grant them access if they are Admiral Live clients. So if you're not yet a live account holder with Admiral Markets, then make sure that you become a client. Then you will have access here in this community. If you do not want to become an Admiral client, no worries, but then you have to hurry up and join the community right now. So just to let you know. And now let's come back here to the ESMA decision here. And we want to, first of all, introduce what happened there. I already said what happened there. In fact, it was the reduction of leverage being offered to retail clients. And not only that, but the main focus was on the leverage here. So on the 1st of August, it's more than 1 year, the European Securities and Markets Authority, short it's ESMA, introduced the following changes to European FX and CFD providers. So leverage limits on trades for retail clients ranging from 30 to 1 to 2 to 1, varying according to the volatility of the underlying asset. So major currencies, 30 to 1, non-major currency pairs, GBP, Australian dollar, for example, but also gold and major indices like the DAX, like Dow Jones, like the S&P 500, 20 to 1. Then we had commodities like gold. I'm sorry, no, that's not right. It should be WTI. It should be crude oil. It shouldn't be gold here because gold is already here. I'm sorry, that's a small mistake. And non-major equity indices. So those who are more illiquid, let's say. Then we have individual equities, respectively, single stock CFDs, for example, and other reference values, and 2 to 1 for cryptocurrencies like Bitcoin and everything. So then in addition to that, there's also the margin closeout rule, negative balance protection, the restriction on the incentives offered to trade CFDs, and the standardized risk warning, which also should include the percentage of losses on a CFD provider's retail investor account. So if you, for example, check the website from Admiral Markets, you will see there is now a disclaimer saying so-and-so many retail traders are not profitable. If you check the same disclaimer 1 year ago, 12 months before, you will see that this percentage did not necessarily change. So all in all, we could already say the ESMA decision to here reduce the leverage for retail clients was not really that successful. And this has mainly to do with the fact that many, even though they are now restricted in the leverage they can use, they still are not trading a profitable strategy, but just buy and sell and hope that the market will move higher or turn lower, but not necessarily based on a proven profitable strategy, in fact. Or to put it differently, now it only takes longer till they crush the account, but all in all, they still do. So it's not limited to the leverage then. It not means that you can reduce the use leverage in your trading, become profitable, but you also have to trade, obviously, a profitable strategy, one with a positive expectancy. And now what I did is the following. Oh, this is a little unfortunate, but okay, still, it's fine. What I did was, I already showed to you here the Trader Spotlight community, and the numbers I used here for this example are based on the numbers from here in the morning. So there you can see it. There we have the open range, and then you have also the setup here, which was stopped out, everything. And we want to now run those calculations here based on ESMA, based on real market numbers in this case, from the morning for this setup in the DAX then. To check out these numbers, again, feel free to come to the Spotlight community there, and you have all the numbers there. So we defined the open range here today in the DAX, according to this ORB setup, between 11,929 to 11,990, so it's 61 points with a point value of one full DAX CFD of €1. So that's one CFD in this case. And oh, I should have. Yeah, we traded below. I'm sorry, I forgot to adopt this. Before the slide had a long example. So today we traded below the EMA 50. So we only took short trades. But what's of more interest here are these two columns, in fact. So before ESMA, this was true. We decided to trade one DAX CFD here. And I already told you that if we trade short here and we enter the market at 11,929, we had an overall value of the position of 11,929 points. I'm sorry, euro. And if we trade this with the leverage being offered by the broker, so here we have the so-called nominal leverage then. If we trade this with the leverage of 100 to 1, the margin for such a DAX CFD was 11,929 divided by 100. And so you had to put in 119.29 euros in your account. You had to have this amount minimum to open the position. You obviously have to have more because this would mean that the market is, there's no spread included and everything. So obviously you need more money in your account than those 119, but still it's only, let's say 200 euros and you could have opened this position easily. So now we assume that we have a 10,000 euro account with 1% risk per trade. So that means we're risking 100 euros. And then we take those 100 euros and we divide this by those 61 points because we entered the market short. And then we have to place our stop at 11,990 points. That was the high of the range. And so we had to make sure that, that results in an overall risk of the position of 61 points. So that means 100 divided by 61, that we are trading 1.6 CFD. And so that means to open the position here, we had, if we wanted to trade 1.6 DAX CFD, we had here to multiply 1.6 with those 119.29, and we had to have minimum 190.86 euro in our account. Okay, that was before ESMA. After ESMA, ESMA came out and said, okay, there we have, in regards to retail clients, leverage restriction of 20 to 1. So we have the same here with one DAX CFD having a value of 11,929 euros. But with a leverage of 20 to 1, the margin for one DAX CFD was then 11,929 divided by 20. And then you had to have, obviously, 5 times as much money in your account here for trading one DAX CFD. So you can see 596.45. And if you now assume you have a 10,000 euro account to trade those 1.6 CFDs, DAX CFDs, you have to have 954.32 euro in your account. So you can see it here at the bottom, hopefully. There. You can see it in red at the bottom of the slide. So obviously more capital is required, 5 times more, but nevertheless, and this is the interesting thing about this, the strategy is still and easily tradable, because if we assume that we have a 10,000 euro account, it doesn't make a difference if we have to put up 1,000 euros or nearly 200 euros here. At the end of the day, we can still trade the strategy. This is probably already giving an answer to why, or it's also an explanation of why the overall profitability did not necessarily increase after the reduction of the offered leverage here when it comes to retail clients, but it comes all down to trading a profitable strategy. Still, again, you will probably not try to eat too much of the candy then, because it means also that, for example, let's say we are still here before ESMA and you say, hey, I have a 10,000 euro account, but I want to see the market, not the market, but my account moving in the one direction. So let's just assume that you decided to trade not 1.6 CFDs here, but 1.6 multiplied with 10. So 10 times the amount. You could easily do that by here then multiplying that number, the margin you have to put up in your 10,000 euro account, 190, let's say 191 multiplied with 10, you come out at 1,900 909 euros in this case. So something like 2,000. Let's round this number up. So you could easily trade a position which is 10 times as large with the offered leverage here of 100 to 1. This is not possible when looking here after ESMA, because now you have to multiply that number by 10. Great, but in a 10,000 euro account, you already have to put up 9,000 and then 550 euros to open the position. So you only have 500 euros in your account. The market can move against you after you get your margin call, which means in this case, after ESMA, chances of you over leveraging your account definitely decreased significantly. Still, it's not resulting in people becoming more profitable because they are offered only a lower leverage. Because again, not having a profitable strategy means only it takes longer, but you will definitely crash the account because this is a given fact based on the expected value of the strategy in this case. So let's look at the summary then. Effective leverage and profitability are tightly connected in trading. The lower the effective leverage in one's trading, the higher the chances of being profitable, but not due to reducing the leverage alone, but by the fact that you offer yourself a chance to make more mistakes in your trading, which you will naturally do. Profitable trading strategies with adequate risk money management are not necessarily affected by leverage limitations as introduced by the ESMA in August 2018. It is also probably something which is very interesting and something I have to add here. The strategy, it's traded, it is a demo account, okay, but still, it's a simple retail demo account with no leverage of 100 or 200 to 1, but the leverage here I use within this trading to demonstrate these trades and to give you an idea of how they work in the real world is limited to 30 to 1, respectively 20 to 1 in this case. So I show by trading these strategies, even if I have two trades open, one in the DAX in the morning and one in the S&P in the afternoon, and the market did not move strongly in my direction or not in the DAX, I have two trades open, but I can easily trade both strategies without overusing leverage. It's not necessary to have a high leverage to trade these strategies. And this is what I mean by profitable trading strategies with adequate risk and money management are not necessarily affected by leverage limitations. There are strategies, yes, but the ones we are presenting here are not affected by them. You can easily keep on trading them even after the leverage restriction by ESMA. And the reduction of the leverage does not automatically mean a trader becomes profitable in his trading. I mentioned this several times now. It only takes longer for him to bust his account if he has not a proven profitable strategy. So this is where it all starts. Make sure that you have a proven profitable strategy, one with a positive expected value in your trading. But if you do not have one, it doesn't mean you'll become profitable by only reducing the leverage. It only takes longer to bleed out, but rather sooner or later, the account will go bust. No question about that. Yeah, and I already mentioned one of the two here, Paul, in our trading spotlight community. He'll be here at the same time on Monday talking to you about the use of Fibonacci retracements and extensions in the MT4, which will include what is Fibonacci and how is it found in financial markets. It's a very interesting concept also for those like me with a mathematical background especially. How do we use it on the MT4? And then he'll also present a simple Fibonacci-based trade setup. It will be on I take the German time, 3 p.m. German time on Monday. So it should be, I think it's 1 p.m. GMT, but it's definitely 3 p.m. German time, same time as today. On Monday, October 7th, check your inbox for the webinar link. All those already here, you can check the inbox because it's a webinar which a real recurrence, I think is the English word for this. So it's the same environment here. If you watch it on YouTube and you haven't yet registered, check out the website from Admiral Markets here in regards to the link. Register and then follow the one here. Check the inbox then on Monday. Admiralmarkets.com is the website where I recommend you to go to. Also here, contact us. Admiral Markets has several ways to be contacted: Facebook, YouTube, and also simply via email. And very important, and this is important especially after ESMA, the risk disclaimer. And with this, I'll wish you a nice weekend. Enjoy yourself. Talk to you again then on next week, Friday, with the next Trading Spotlight webinar. I hope I could deliver some value for your trading. And also feel free to ask all your questions in the Trading Spotlight community there. I'd highly appreciate it to answer your questions if you have some. And yeah, that's it from my end. So have a nice weekend. Talk to you soon. See you. And